Today, folks, I have finally taken a stake in what I believe will be the interest rate recovery plays. And what do I mean by that? Well, interest rate sensitive stocks, your infrastructure, your real estate that heavily rely on lower rates to have better cash flow will likely start to see recovery in their earnings and start seeing a boost in their earnings as interest rates cut. It almost feels like the easiest play imaginable. It just makes logical sense. And I'm finally starting to buy stocks, and I already own stocks that are starting to see some effect of this. I believe this is the start of this turnaround because we're seeing it in a lot of dividend plays, which historically and tend to have higher debt on the balance sheet. So what we're going to do is play this thesis out, take a look at the stocks that I'm buying in my portfolio. We're going to review some earnings from some dividend stocks like 3M, and then broad view the earnings we're going to get next week and kind of compare them to what happened this week. And if that is a conversation you'd appreciate, damn it, hit that like button. If you're on a path to financial independence to perhaps one day retire early, consider subscribing while you're down there. But my big thesis that I don't think people can ignore is the trillions of dollars that have been added to money market funds. This is like bolstering, the US dollar. People have been flooding into US dollars, getting these high interest savings accounts, whether it's money market funds, bonds, GICs, they're just flooding into cash because you can get 4 to 5%, heck, sometimes over 5%. But those days are starting to be behind us, which means all these extra trillions of dollars that have been added to these money market funds, especially just within the last couple of years, is probably going to start looking for a new place to get a higher rate of return, and probably not looking for tech in particular because, let's be real, tech is growth oriented, it's volatile, and whoever's putting money in money market funds is probably more concerned about the security. So I personally believe that money will eventually start finding its way into the lower half of the market where valuations make more sense and where dividend yields are still at historic record level highs. So I'm predicting that some of the best stocks that are going to see the best performance are going to sit within the Dow, represented by SCHD, which we'll take a look at, has been crushing it recently. I just started buying a position in VNQ, which is the broader US real estate ETF offered from Vanguard. We're going to break that down. And VDY, I've been speculating on the recovery play in Canada because that's more or less financials, and the financials have just not been performing as well as they should be. But I'm also bullish that over time they will start to do better and probably lift this ETF regardless of where interest rates are. They just need a more sustainable economy, which will be more sustainable in a lower interest rate environment. Alleviate some of the concerns about people thinking real estate or financials are going to collapse. I don't think that's going to happen. If you do, you probably shouldn't be buying these kind of stocks. However, let's get into some of these individual positions when it comes to these ETFs and just kind of where they sit, because over the week, we've really seen tech start to correct a bit, only to rally back. So congrats to anyone that kept buying. Like I said, I bought some of the dip here. I wish I bought it a day or two ago, but I had to wait for some paychecks to come in from work. But we can see that the lower half of the market, these dividend-oriented plays, are the ones that are starting to really see a oomph and a benefit, especially after some earnings when it came to things like AbbVie and some of the healthcare sector. Your Procter & Gamble's, Pepsi's been seeing some nice little rallying going on there. But yeah, the lower half, the Dow-oriented stocks have really lifted off, and we've seen that in SCHD, which I want to point out we're getting into some really great, remarkable returns here because we were getting about a 3 to 4% dividend yield, which means we're over 10% if we just stay where we are today with the capital gains. I mean, this is an all-time high now for SCHD, which is something we really haven't seen since 2022. And a lot of people will use this as an excuse to be like, well, I'm not going to buy a stock that's down, that's been underperforming. But it's like you have to buy the stocks when they're down to get the performance when they're up. And I think we're starting to head into that up phase because we're also seeing it with VDY. I mean, VDY is nowhere near its all-time high yet. It's been very suppressed in the Canadian market, and I still think is trading at a very favorable value, with the two biggest positions being Royal Bank and TD that is still at a very discounted level. So I'm going to hold this. I'm not really looking at it as much of a recovery play, though it does have stocks like Enbridge in here, some energy stocks. It'll benefit from the interest rate cuts, but for the most part, I don't think the banks and some of the holdings are as interest rate sensitive as some things in SCHD or, for example, VNQ are. I mean, VNQ is an entire ETF that is largely predicated on what's going to happen with interest rates, and I'm going to break that down for you right now. So at the end of the day, total return matters a lot. I want to say that first and foremost. VOO, the end all be all to my portfolio, will always be 50%, always putting money here, but we're always trying to inch out some outperformance, whether it's leveraging individual tech companies, taking advantage of some of the rallies, or trying to look for these interesting plays where I can get some income and potentially higher performance returns than we've seen in the past because these stocks are trading at such discounted levels. And that's essentially what I'm trying to do here. Because if we look through past performance on VNQ, this is not an ETF at any other time I'd really recommend buying. Honestly, I was looking at some of the individual REITs to take advantage, to get a higher rate of return out of this, but I'm not really predicated to want to take on that much risk. Ideally, I figure if I can buy this at a cheaper level today with the assumption that we should get outsized returns, I might even be able to hold on to this ETF much longer, collecting some dividends and reinvesting that into the S&P 500. And if we take a look at these top holdings here and we just look at how they've been doing so far compared to where I think they're going to be doing in the future, we'll break down maybe the top 6 or 7 stocks here that make up probably about 30% of this ETF, give or take. We're going to look at PLD, Prologis, American Tower, Equinix, Welltower, which is, some of these are, healthcare related. Some of them are like Prologis, cloud computing data center related. Some are telecommunication related. I love the diversity in here. You got retail, like realty income. You got digital realty income. If we just take a look at some of the composition and why I like this as well, the diversity is great. You get good exposure to what I believe to be some of the fastest growing areas, and we'll see some of the best recoveries in the real estate sector when it comes to data centers, when it comes to healthcare. If we take a look, industrial REITs have done exceptionally well in here. Even retail, I don't mind as much. You got telecom towers, which always do very well. I mean, American Towers, I guess, close to one of the largest companies for real estate in the U.S., and they just rent land to companies like AT&T to put up cell towers. So let's talk about, first and foremost, the top holdings. I'm going to go through this really quick so I do not bore you as much, but I want you to understand we've been in a period for infrastructure and real estate plays that have actually seen exceptional growth, but their earnings have been limited by interest rates, more or less. That's the story, right? We've talked about this with telecom providers like TELUS. We're talking about stocks here that literally see record revenue growth. They had slowed down a little bit, but we're still seeing with Prologis, for example, double-digit revenue growth. But when we actually take a look at the net income, we can see that it's flatlined or has actually declined, thanks to the interest rate cycle and usually the debt on these companies, right? So earnings per share growth has not been there, which means the stock hasn't performed nearly as well. American Tower, all-time high, record revenue growth, right? If we take a look at net income, again, the income is starting to recover, but we're still nowhere near all-time high net income. Let's take a look at this one. This one's very stable. I mean, we're talking about consistent double-digit revenue growth, very consistent company with Equinix here. We take a look at net income. This one, unlike the others, has actually seen some good net income, but not a lot of net income growth. It's actually been relatively flat. You get some negative months, you get some good months, but overall, not nearly the growth that we've seen over the prior years. That's probably one of the few exceptions. We also have Welltower here. This one doing very well from a revenue growth standpoint, also in the double digits. For real estate to be growing revenue at 10 to 20% clips is almost the equivalent of some of the numbers these tech companies are putting up. And I want you to keep that in mind. Like, I think what was the last earnings revenue growth for Google, I think was like 14% or something like that. Yet we can see the net income here for Well is just absolutely in the toilet and is just starting to recover now, right? These companies have just found their bottoms and they're all starting to level off, and they're going to potentially start seeing rallies in their earnings per share. I mean, let's take a look at this one here. We got Simon Properties, another one that has not seen really great revenue growth, but we're starting to come back. It's like at least revenue's growing back up. But if we take a look at net income, well, it's actually not too bad. Net income's finding an all-time high here. So here's another exception, right? Let's take a look at DLR, Digital Realty here. It actually saw its first negative quarter of revenue growth, flat for the most part. So not a whole lot of growth for the first time in its entire history. But if we take a look at net income has not been doing as exceptionally well as it had been in the past, though it's starting to get better, right? You're seeing a sign here. It's all starting to get better. Let's take a look at realty income, a fan favorite here. If we take a look at this massive growth rate, and we're talking about 20, 30% revenue growth numbers, even in 2024, I know it's mind-blowing in this higher interest rate environment, yet net income is flat and actually downtrending. So you can see the common denominator between a lot of these REITs is the same story. It's the same common denominator. It's all interest rate affected. They've been fighting, still growing revenues. Obviously rents have been going up, but it hasn't been offsetting the debt and some of the other, depreciation, amortization costs and things they've been trying to take advantage of to deal with this interest rate environment. So I'm very bullish that what we're about to see is the start of continual interest rate cuts, probably till we get somewhere closer to 2 to 3%. That's where I figure we're going to bottom off for a little while. But historically, the way it works is because people get into office, people want to stimulate the economy. We did very well for a decade at almost 0% interest rates. I don't think we need to get to zero, but realistically 1 to 2%, I don't think hinders the economy. I think it helps it propel and grow. And that's where we're going to go back to eventually. How long it takes, I don't know. But in Canada, we have already done a 0.5% interest rate cut. And if we take a look at how that performed for some of the Canadian real estate out there with like the Vanguard Canadian Capped REIT ETF, we take a look at a year to date, and this thing has absolutely started to propel to the upside, 15%. Historically, whatever happens in Canada tends to happen 2 to 3-fold in the US. And this is an ETF, keep in mind. I mean, so I'm on the bleeding edge here of presuming that this is going to be a recovery. This is what we're going to see. And if I can get that kind of performance out of an ETF while I'm collecting a 4% dividend yield, that is going to be a very healthy return that is above average in the sector, right? So that's what my thinking is right now. I'm seeing the same thing, again, with everything from telecoms to industrials to you name it, right? I mean, you look at something like TELUS as an example, it looks exactly the same. You know, these telecom giants have been, some of them making record revenues, yet their net income is in the toilet. So I'm very excited to see if this thesis comes into full fruition here. I know a lot of people have been picking individual REITs and they've been having a hard time stomaching the volatility, but in moments like this, you could see definite outsized returns paying off that volatility. And I think we're starting to see a lot of people get a lot more bullish on these dividend stocks that have been devastated because 3M posted earnings that I wouldn't think were incredible. They weren't astounding, yet the stock just absolutely exploded. I mean, in a week, it's up 22%, showing people actually starting to care about these again. So why is 3M up? According to the second quarter earnings results beat analyst estimates. But the thing is this revenue isn't great. It's flat. Net sales year over year hasn't done anything. It's all flat. You know, net income, you know, yeah, for the most point for the 6-month end, it's flat. For this, you know, quarter, it's not terrible. But all in all, there hasn't been any growth in this company. In fact, it's been declining. You know, so this is finding a bottom, right? And I feel like people might be thinking, hey, 3M finally found its bottom, and then look what happens when we start projecting that into the future. I think that's what's going to start to happen with REITs and many other dividend plays. So I'm very, very excited to see how SCHD continues to perform. I'm glad these are larger positions within my portfolio. And they're ETFs, which make them much less volatile, much more safer. Am I going to lose some upside? Absolutely. But that does not mean we can't outperform in a market where tech is fairly valued. Now, I wouldn't steer away from tech. If tech corrects enough here, I'd be open to buying it. But as I mentioned in my video yesterday, I get good exposure, about 20% sector exposure just with, you know, my holdings in VOO and, you know, some of these other ETFs. But like I said, if it comes favorable to me again, maybe I'll buy some Tesla, maybe I'll buy some other tech. But keep in mind, my fiance, her portfolio, if we're combining them here, she has good tech exposure already. So I'm looking at the interest rate recovery play, and we'll see how it all comes into fruition. But at least we're collecting a very nice 2.5% yield. I know it's not crazy, but hey, it's something while we wait. So finally, what's coming up next week, I think, is going to be another return to growth for the most part. I know we didn't see the best performance out of companies like Visa. PayPal's going to be interesting. It's usually a bit of a mixed bag, but honestly, I'm shocked to see with 3M, AbbVie, and some of these other performance, dividend-oriented stocks. I think we're in a great position for the kickoff of next week to be McDonald's, Procter & Gamble. You know, Pfizer's going to be playing in there, which is also a fun one to look at. Altria Group, there's so much going on. Apple, obviously we're getting Canadian Natural. It's a big one in Canada. Amazon, whew, baby. It's going to be an exciting weekend. If it's something to look forward to and you want to go through it with me, man, Microsoft, the whole 9 yards, consider subscribing. But I'd love to know what you think about all of this and how you're playing it in that comment section below.